The middle class is under pressure like never before. Rising home prices, crushing mortgage rates, and hidden costs are making ownership feel impossible in 2026. Watch as we reveal why buying a house may not be what you think and how to protect your finances, make smart choices, and escape the affordability trap before it's too late. For decades, the middle class was told a simple story. Work hard, earn steadily, save responsibly, and one day you will own a home. That home would represent stability, dignity, and progress. It would be the physical proof that your effort meant something. In many countries, this promise shaped life decisions. People chose careers, cities, and lifestyles around the expectation that homeownership was achievable with discipline and patience. But in 2026, something feels different. Salaries have increased slowly, yet housing prices in many areas have accelerated far beyond wage growth. A generation that followed the traditional path now finds itself priced out of neighborhoods it once assumed would be within reach. Middle-class families with stable jobs, decent credit scores, and years of savings are discovering that the goalpost keeps moving. The issue is not only high prices, it is the growing gap between income and housing costs. When homes cost 6, 7, or even 10 times annual income, saving for a down payment becomes a multi-year challenge. During those years, rent continues to rise, groceries become more expensive, and daily expenses stretch budgets thinner. The financial pressure builds quietly, turning what once felt like a milestone into a source of anxiety. Another part of the crisis is expectation. Social media amplifies homeownership as a symbol of success. Photos of new keys and housewarming celebrations create subtle comparisons. When friends and peers buy homes, those still renting may feel behind, even if their financial decisions are rational. Emotional pressure combines with economic reality, pushing many into rushed decisions. At the same time, lenders evaluate affordability differently than households experience it. A bank may approve a mortgage based on income ratios, but that approval does not guarantee comfort. Being approved for a loan does not mean the monthly payments will feel manageable once property taxes, insurance, and maintenance enter the picture. The middle class often discovers that technical affordability is not the same as sustainable affordability. Urban development patterns also play a role. In many cities, demand for housing in desirable neighborhoods exceeds supply. Limited land, zoning restrictions, and construction costs contribute to higher prices. As new developments target higher income buyers, mid-priced housing options shrink. The result is a squeeze in the middle, where families earn too much to qualify for assistance, but not enough to compete easily in hot markets. The psychological toll cannot be ignored. Home ownership has long been associated with adulthood and stability. When capable, responsible individuals cannot access that milestone, frustration grows. It feels as if the system changed without warning. The promise of upward mobility appears less certain. Yet this crisis is not about hopelessness. It is about understanding. Before making a decision, the middle class must recognize the forces at play. Rising prices, stagnant wages, limited supply, and social expectations combine to create today's pressure. Ignoring these dynamics can lead to emotional buying and long-term strain. Homeownership has begun to feel distant for many middle-class families. The middle-class housing crisis is not driven by emotion alone. It is rooted in math, and the math has shifted dramatically over the past decade. One of the most important factors is the price-to-income ratio. Historically, homes in many regions cost 3 to 5 times the average annual household income. That ratio allowed families to save for a down payment within a reasonable time frame while maintaining normal living expenses. In 2026, in numerous urban and suburban markets, homes often cost 6 to 10 times annual income. This expansion alone reshapes affordability. When home prices rise faster than wages, the gap compounds over time. Even steady salary increases struggle to keep pace with double-digit property appreciation during boom cycles. A household earning a solid middle-class income may technically qualify for financing, but qualification is not the same as comfort. The monthly obligation relative to take-home pay often becomes far heavier than it was for previous generations. Interest rates add another layer of pressure. A mortgage rate difference of just 1 or 2 percentage points significantly affects monthly payments and total interest paid over decades. Higher rates reduce purchasing power, meaning buyers either settle for smaller homes or stretch their budgets further to afford similar properties. In tight markets, this dynamic intensifies competition and pushes prices upward. Down payments represent another barrier. Saving 10 to 20% of a rapidly increasing home price requires discipline and time. Meanwhile, rent payments continue, often rising annually. The longer it takes to save, the higher the target becomes. This cycle can make buyers feel as if they are chasing a moving finish line. Beyond the headline price, ownership includes additional expenses that strain middle-class budgets. Property taxes can rise with home values. Insurance premiums fluctuate based on regional risks. Maintenance costs are unpredictable yet inevitable. A heating system replacement or roof repair can consume savings quickly. These ongoing obligations mean that even after securing a mortgage, financial pressure does not disappear. Debt levels also influence the equation. Many middle-class households carry student loans, car payments, or credit card balances. These obligations reduce borrowing capacity and increase total monthly commitments. When combined with a mortgage, overall debt ratios can approach uncomfortable levels, limiting flexibility in emergencies. Inflation compounds the challenge. Everyday expenses, such as groceries, utilities, childcare, and transportation, have become more expensive in many areas. Even if income rises moderately, purchasing power may not improve significantly. Competes with all other financial priorities, including retirement savings and emergency funds. Another overlooked factor is opportunity cost. Large down payments tie up capital that could otherwise be invested in diversified assets. When housing prices are high relative to income, concentrating wealth in a single property increases exposure to local market fluctuations. For families seeking financial resilience, this concentration can feel risky. The numbers reveal why the crisis feels so widespread. It is not that the middle class lacks discipline. It is that the structure of affordability has shifted. Higher price-to-income ratios, rising rates, heavier upfront costs, and increasing living expenses combine to create sustained pressure. Understanding these mechanics is essential before making a major decision. Emotion may push families to act quickly, but clarity requires careful calculation. Financial pressures influence lifestyle choices and long-term security, and whether buying under strain truly delivers the stability it promises. Rising price-to-income ratios, higher interest rates, and escalating living costs have tightened affordability. But the financial math is only part of the story. The deeper impact appears in daily life, where budgets stretch thin and long-term security feels uncertain. For many middle-class families, buying a home today requires stretching beyond what feels comfortable. The mortgage payment may technically fit within lender guidelines, yet once utilities, insurance, property taxes, and maintenance are added, the margin for error shrinks. That shrinking margin quietly reshapes lifestyle choices. Vacations become rare. Dining out decreases. Emergency savings grow slowly, if at all. Every unexpected expense feels heavier. The illusion lies in the word stability. Owning a home has long been associated with security. There is comfort in knowing that you cannot be asked to leave by a landlord. There's pride in customizing your space and planting long-term roots. However, stability built on financial strain can feel fragile. If one job is lost or one medical expense arises, the pressure multiplies quickly. Career mobility is another hidden trade-off. In an economy where industries evolve rapidly and remote work changes location flexibility, being tied to a property can limit opportunity. Selling a house involves transaction costs, market timing, and uncertainty. When prices are high and markets unpredictable, relocating for better employment becomes more complicated. What once symbolized freedom can quietly reduce flexibility. The lifestyle squeeze also affects mental health. Constant budgeting, fear of rising expenses, and anxiety about repairs create background stress. A broken appliance or unexpected tax increase becomes more than an inconvenience. It becomes a financial threat. Middle-class families often absorb this stress silently because outwardly, ownership appears successful. The pressure remains hidden behind freshly painted walls. Social expectations intensify the situation. Friends, relatives, and online communities often celebrate ownership as progress. When families stretch finances to meet that expectation, they may hesitate to admit discomfort. The narrative of success discourages honest conversations about strain. As a result, many households carry similar burdens without realizing how common the experience is. Children and future planning also enter the equation. Education savings, retirement contributions, and investment goals compete with mortgage obligations. When housing consumes a large share of income, long-term wealth building may slow. Ironically, the asset meant to create financial security can delay broader financial growth if it dominates cash flow. None of this means ownership is inherently harmful. For families with strong financial cushions and stable income, the lifestyle adjustments may feel manageable. Over time, appreciation and equity growth can reward patience. The issue arises when purchasing decisions are driven by urgency rather than readiness. Stability requires breathing room, not constant tension. The middle-class housing crisis is not only about numbers, it is about daily trade-offs. It is about whether the home enhances life or restricts it. It is about whether ownership expands opportunity or narrows it. When evaluating whether to buy, families must ask honest questions about flexibility, resilience, and comfort. Lifestyle squeeze turns homeownership from a symbol of stability into a source of pressure for many middle-class families. The question now becomes practical. If traditional buying feels financially tight, what are the strategic alternatives? The middle-class housing crisis does not eliminate opportunity, but it demands smarter, more intentional decision-making. The first alternative is patience with purpose. Waiting is often portrayed as falling behind, yet strategic waiting can strengthen financial positioning. Additional time allows families to increase savings, improve credit scores, and reduce high-interest debt. A larger down payment lowers monthly mortgage costs and reduces overall interest paid. Strengthening the financial foundation before purchasing can transform a stressful commitment into a manageable one. Renting, when done intentionally, can also be strategic. Rather than viewing rent as wasted money, families can treat the difference between rent and a potential mortgage as investable capital. Consistent investment into diversified assets builds wealth through compounding. Over time, disciplined investing can rival or even exceed the equity growth of a home, especially in markets where price appreciation slows. The key is discipline. Renting only becomes powerful when savings are actually invested rather than consumed. Location flexibility presents another opportunity. In many regions, housing affordability varies dramatically between neighborhoods and cities. Remote work has expanded geographic options for some professionals. Choosing a lower-cost area can dramatically reduce financial pressure while still allowing property ownership. The trade-off may involve commuting patterns or lifestyle adjustments, but the financial relief can be substantial. Another path involves redefining the type of property purchased. Instead of aiming immediately for a large single-family home, buyers might consider smaller properties, condominiums, or multi-unit homes. A duplex, for example, can generate rental income that offsets mortgage costs. While this approach introduces landlord responsibilities, it can transform housing from a pure expense into a partially income-producing asset. Partnership models are also emerging. Some families pool resources with relatives to purchase property together. Others explore co-living arrangements to reduce individual burden. These solutions require trust and clear agreements, yet they illustrate how creative thinking can expand access without extreme financial strain. Financial education plays a central role in every alternative. Understanding loan structures, comparing fixed and adjustable rates, analyzing total ownership costs, and projecting long-term affordability empower buyers to negotiate confidently. Too often, decisions are made based on emotion or external pressure rather than detailed analysis. Clarity reduces risk. It is equally important to separate identity from timing. Delaying ownership does not diminish financial maturity. In fact, choosing patience when numbers do not align demonstrates discipline. The middle-class housing crisis has shifted the environment, but it has not eliminated personal agency. Families can still design strategies that protect their long-term goals. The broader lesson is flexibility. Economic cycles evolve, interest rates rise and fall, markets cool and recover. Those who maintain liquidity and resilience can adapt more easily than those stretched to their limits. Strategic alternatives are not about abandoning the dream. They are about approaching it from a position of strength rather than urgency. Throughout this discussion, we have examined how the middle-class housing crisis emerged, how the numbers shifted, how lifestyle pressure intensified, and what strategic alternatives exist. Now we arrive at the central question. How can the middle class move forward in a housing market that feels increasingly out of reach? The answer is not found in panic or blind optimism. It is found in discipline, clarity, and long-term planning. The first step toward rebuilding stability is redefining success. For decades, owning a home as early as possible was seen as proof of progress. In today's environment, financial resilience may be a more accurate measure of success. A strong emergency fund, low high-interest debt, steady investments, and manageable housing costs provide more real security than a mortgage that consumes most of one's income. When stability becomes the goal rather than status, decisions improve. Preparation must replace urgency. Before committing to ownership, households should calculate total housing costs conservatively. Mortgage payments are only part of the equation. Property taxes, insurance, maintenance, utilities, and potential repairs must be included. If those combined costs leave little room for saving or investing, the purchase may require reconsideration. Sustainable homeownership means having financial breathing space. Income growth also plays a crucial role. Investing in career development, skills training, or entrepreneurial ventures can increase earning potential. While housing prices are influenced by markets, income growth is partially within individual control. Community and policy trends may also influence the future landscape. As affordability concerns grow, conversations around zoning reform, housing supply, and development incentives continue in many regions. While individuals cannot control policy directly, awareness of broader shifts helps families anticipate opportunities. Markets evolve, and patient observers may find more favorable conditions over time. Diversification remains essential. Even after purchasing a home, relying entirely on property appreciation for wealth creation can be risky. Balanced financial planning includes retirement accounts, diversified investments, and liquidity reserves. A home should be part of a larger strategy, not the sole pillar supporting financial security. Emotional readiness matters as well. Ownership requires commitment, not only financially, but mentally. Repairs, long-term maintenance, and neighborhood dynamics all demand attention. When families enter ownership prepared for these realities, stress decreases. When expectations are unrealistic, disappointment grows quickly. The middle-class housing crisis is real, but it is not permanent or universal. Some markets remain more accessible than others. Some households are better positioned than others. The key distinction is intention. Buying a house should align with long-term plans, stable income, and disciplined budgeting. It should enhance life, not dominate it. Ultimately, rebuilding the path to sustainable homeownership requires patience and perspective. The dream itself is not flawed. What has changed is the environment around it. By strengthening financial foundations, expanding income potential, diversifying investments, and resisting external pressure, the middle class can still pursue ownership wisely. The crisis has forced a necessary shift in thinking. Instead of asking, how fast can we buy? The better question becomes, how strong are we before we buy? When that question is answered honestly, the path forward becomes clearer. Homeownership, approached strategically, can still represent stability and growth. The difference lies in preparation, not pressure.